This year has been one of the most challenging years as an investor, and everyone's asking the same question. What should I do? What changes should I make? Here's how I'm investing for 2022. I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Guys, I've been through a lot. I've been in this career for a couple of decades, and I've seen a lot of different market environments, and each one has similar lessons. Each one is unique in its own way. This one's challenging. 2022 is challenging. We've talked about it several times. How do you invest during volatility? And more specifically, how should you have been investing? How should you be investing in 2022? This is a question we're getting all the time. You've likely asked it as well. Do I need to make changes? What should I be doing to invest and navigate this really, really challenging market? And I'm going to share with you what I'm doing, how I invest in 2022. It's not dramatically different than when we still sort of expected this wasn't going to get as bad as it did. And not much has changed, okay? And that's really the biggest thing, is you need to know, are you a trader? Are you an investor? Or are you a saver? And the big thing, before I get into the actual applications, you've got to know who you are and stay in your lane. Now, there's a lot of people that thought they were traders that weren't really using a well-defined process that they've seen work during all sorts of cycles. Most people that are new to the trading game, day trading, weekly trading off of some sort of technical indicator, something like that, they got into it quickly because they thought they could, gamble, get rich quick, that sort of thing. And they didn't recognize that markets are cyclical, stocks are cyclical, and they didn't test that overall strategy during great times and bad times. Successful traders, those of you that have the aptitude to take that level of speculation and risk, and are smart enough to employ a strategy that works in great times, works in terrible times, and have the amount of time to devote to it, stay in your lane. Hopefully, you're working a strategy that, and certainly I haven't found anyone that's been able to avoid completely downturns and capture upside. That doesn't exist. Hopefully, you're working a trading strategy that has been able to help you navigate during this time period. Okay, that's you traders. Okay, savers, on the other side of the spectrum, really aren't comfortable taking any investment risk. And you need to be aware of that. And if that's you, you got to stay in your lane. Maybe you're doing a little bit of investing, but you've got that surrounded with a large moat of cash and very safe, steady, predictable assets, okay? For you, don't get greedy. Don't over-speculate. Don't get too aggressive with your investments. Instead, face the reality that you're probably going to need to save up more, spend less, work longer, those sorts of things, because you're going to have a lower assumed rate of return. That's okay. Mostly I'm talking to those of you in the middle, and that is investors, long-term investors, that you should have a tried and true investment philosophy that is designed to work when markets are appreciating, but also designed to play defense. I mean, basically what you have on the floor, I'm a hockey player, so what you have out on the ice, you've selected your team. You're gonna have 3 offensive players, 3 defensive players, but you're gonna decide how much offense and how much defense are you gonna be playing at any particular time. And you're gonna go in with a game plan, and the big idea for long-term long-term investors, don't deviate from the game plan. Expect that there's going to be times when you're going to score a lot of goals, there's going to be a lot of offense, and then expect times you're going to need to play a lot of defense as well. All right, so I digress. How should you be investing for 2022? How am I investing for 2022? Well, my overall philosophy, and ours here at KFG, is that you need to have a diversification of strategies. So, number one, I'm still investing. My core strategy is still in diversification, okay? Holding, and to my core, I believe this because it's the evidence-based approach that just because it's up to a couple weeks ago, the S&P 500 had been negative 9 out of 10 weeks in a row, or 9 out of the 10 last 9 out of the 10 previous weeks, if I can say that. That hasn't happened in decades and decades, and not good company for that as well. Well, interesting. Just because it's raining today or it's been raining for the past 9 days doesn't mean it's going to rain forever. Just because it's been sweltering hot and the sun's been shining for 9 straight days doesn't mean it will be sweltering hot forever. Same thing in the markets, okay? And so diversification is that tried and true, that evidence-based approach where selecting high quality investments, low cost investments that cover all diversified areas, so large cap US, mid cap US, small cap US, international, emerging markets, real estate, various spots and bonds, commodities, that sort of stuff. Right, picking that diversified mix, not having all your eggs in one basket, getting the right recipe there, and then that is going to be your offense and defense. You're going to ride that through the ups and downs. That still is what I believe should be your core strategy. Now, the challenge and the reason why our philosophy is that you need to have more than your overall investment philosophy should be more than just diversification is because when you want diversification to work the most, it tends to fail. When everything goes into crisis and everything starts dropping, that means diversification is failing. Everything's moving in the same general direction. At the time during a crisis, when you want diversification to work the most, it typically fails. That's why, in addition to a diversification strategy, I also use a momentum strategy. It's not perfect, but it's taking a look at the various spots within that overall diversified portfolio. Which areas, which slivers have momentum right now? And tricky, momentum can change on a dime. Momentum, something can have a confirmed strategy. Okay, it's moved significantly in one direction over a certain period of time. Right as you jump in and say, well, now that's going to keep moving that way. It might reverse course. It's not perfect. You need to have an unemotional system for monitoring momentum in the markets because when everything correlation, when all those areas of diversification start failing, that momentum strategy can pivot and move to cash, or because when in crisis moments, when everyone goes risk off and everything starts moving in the same direction, the only thing that is your safety net is cash. And if it's just based on emotion, you moving to cash, it's not going to work because you won't want to invest when you need to. You're not going to want to get back in, just like you didn't want to get out when you should have. You're not going to want to get in when you should. And so an unemotional momentum system, it is not perfect, but one that can adapt because it's also in a diversified market, in a diversified strategy, you're going to always be upset with some of your investments. Now, rethink when everything's going up, some of your investments are going to be trailing in a diversified strategy. So a momentum system hopefully is able to identify those areas, whether they're small or broad, those areas that are advancing and you're going to overweight there as opposed to just holding a little bit of everything. So to us, I would have a balance in both. Have some in that diversification, that proven long-term evidence-based approach, but still have some in a momentum strategy. And then the third strategy that I've been using is a hedge type strategy. It's one where you're invested in the index and you're limiting some of your downside that you can experience, and in exchange, you're capping some of your upside. Now, anyone would look at that and say, well, geez, when the market's down 25%, that's foolish to cap your upside. I agree, it is. Going into this season, though, for the past 12 months, we've been saying, I can't pick the timing of this thing, but geez, this market looks a little too frothy. The market seems to have out-punted its coverage. The market seems expensive. The valuations seem high. Now, it could stay this way for years. We don't know what and when things will correct, but gosh, based on historical references, this market seems a little too hot, okay? It's at those times that you'd say, well, I still want to participate in the upside, but just in case things start going down, I want to limit some of my downside. The other reason why we've been using this more as a strategy as part of that overall philosophy of using multiple investment strategies is because typically when you're saying, well, things are getting a little expensive and there's more volatility on the stock side, let's shift more into bonds. This has not been a great environment for bonds. And I'm not just looking in the rearview mirror projecting that forward. Well, it's been raining for the past 9 days. It's going to continue to rain the next 9. No, if you look at bonds and where interest rates are, where the yield curve is, it's no surprise that bonds have had a rough experience in 2022, right? And it's hard to take a look at an outlook and say, yeah, you know, I think things are going to get better for bonds. That's going to be hard to say. So if you're trying to reduce volatility, shifting from stocks to bonds, the old conventional approach has some drawbacks at the moment. And so using a hedged or buffered type strategy in conjunction with diversification and a momentum strategy can help create greater diversification and help manage volatility. Those are just some ideas. What's your philosophy, and what are the investment strategies that you're using, the tried and true strategies you're using to accomplish that philosophy and help you reach your financial goals? Work with your certified financial planner. Make sure that you're following the right investment philosophy and that you've got the right strategies for your financial plan, for your risk tolerance, and your unique financial situation to carry out that philosophy during whether 2022 we've seen the worst of it and it's going to recover from here, or it gets worse, or it plateaus right here for a long period of time. Work with your CFP. Make sure you've got the right investment strategies. If you don't have a CFP on your team, want a second opinion, want us to take a look, we'd be happy to. You can contact us at Korhorn.com. That's Korhorn with K. WiseMoneyShow.com. You can find us here as well. You could give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.